Sige, it's recorded now. Go ahead.
Nakikita ba yung screen, sir? Yung video?
Yep.
Please let me know, sir, if the audio can be heard as well.
Okay.
Good evening, Professor Velasco and classmates.
Okay.
How's the relationship
Okay, sir.
Yes.
Thank you.
exist between voluntary disclosure, earnings quality? Good evening, Professor Velasco and classmates. Does a relationship exist between voluntary disclosure, earnings quality, and cost of capital? This evening, my partner Ali and I will present the paper written by Francis, Nanda, and also. Our presentation will follow the general flow of the paper, where we will begin with a short introduction followed by author's hypothesis. Then we will briefly discuss the test variables used, the empirical findings of the test results, then end with the author's conclusions. Under the main question asked earlier, the paper explores possible answers to the following questions. If there is indeed a relationship between voluntary disclosure and earnings quality, and by earnings quality, this refers to the precision of the earnings signal financial reporting system, is it substitutive or is it complementary? Substitutive refers to the relationship wherein firms with poor earnings quality will issue more expansive disclosures because information asymmetry between the firm and investors is higher in such firms. This also means that a firm with good earnings quality will issue less expansive disclosures because information asymmetry is lower in such firms. By contrast, complementary refers to the relationship wherein firms with good earnings quality will issue more expansive disclosures because investors will treat such disclosures as more credible. In the same way, firms with poor earnings quality will issue less expansive disclosures because investors will treat such disclosures as less credible. And finally, the authors ask, do voluntary disclosures result in a lower or higher overall cost of capital?
In this section, we will be discussing the hypotheses tested by the authors, as well as go through some related literature exploring the relationships of voluntary disclosure, earnings quality, and cost of capital. Under hypothesis 1, the authors tested the relationship between earnings and disclosure, particularly whether there is positive or complementary relationship, or the level of disclosure increases as earnings quality increases, or whether there is a negative or substitutive relationship between the two, or the level of disclosure decreases as earnings quality increases. For the second hypothesis, the authors explore if the level of disclosure of a company has an impact on the cost of capital of the firm. And lastly, the authors examine the relationship between the firm's disclosure choice and cost of capital, conditional on earnings quality. Empirical studies of the relationship between voluntary disclosure and financial information quality have found substitutive as well as complementary relations, depending on the measures of voluntary disclosure and information quality examined. So under the substitutive relationship, information asymmetry between firm insiders and shareholders creates a demand for disclosure and provides an incentive for firms to disclose because the value of additional information is greater in these settings. So this implies that firms with poor earnings quality will issue more expansive disclosures because information asymmetry between the firm and investors is higher. So this is because disclosure mitigates the information asymmetry in the market so that firms with greater asymmetry increase disclosures to improve shareholders' information environment. Under the belief that earnings quality is causally related to information asymmetry, the level of a firm's disclosure is inversely correlated with earnings quality, or a substitutive relation. So some argue that this intuition ignores the fact that in such a setting, the firm's disclosures should also be based on poor quality information, and a rational expectations market will place less credence on such disclosures. One of the previous studies conducted used AIMR scores, or Association for Investment Management and Research scores, as the proxy for voluntary disclosure, and researchers found that firms with low returns earnings correlations have higher AIMR scores, or higher level of disclosure. Also, a study by Penno states that if higher information quality significantly lowers the probability of being informed, disclosure may substitute for information quality, or even though there may be less credibility associated with firms with poor earnings, the disclosure may still substitute for information quality as way of reducing information asymmetry in the market. Under the complementary relationship, as information quality increases, such that the quality of the manager's information increases, managers have incentives to disclose more. So under this view, firms with poor earnings quality will issue less expansive disclosures because investors will treat such disclosures as less credible. So two studies examine the probability that a manager is privately informed and investigate his decision to disclose or withhold his information. So they found that as the probability of being informed or information quality increases, the probability of disclosure also increases, since the market is more likely to interpret non-disclosure as bad news and consequently discount the firm's value. Another study found that equilibrium disclosure threshold, or the level at which the company thinks information is substantial enough to disclose, decreases, and the probability of disclosure increases as the precision of a manager's private information increases. So the intuition here is that because market participants know the precision of the manager's private information, if a firm with high quality information withholds information from the market, a rational expectations market will discount the value of the firm's assets. So this force causes the firm's disclosure threshold to decrease and the probability of disclosure to increase, resulting in the prediction of more disclosures for firms with good information quality, or a complementary relation. So other studies have taken a look at the frequency that firms forecast its series and found these to be negatively related with their earnings volatility, or a complementary relation as well. For the relationship between voluntary disclosures and cost of capital of the firm, the theoretical disclosure literature's central premise is that adverse selection among differentially informed capital market participants inhibits investments in a firm's equity. So as a result, an equity issuing firm is motivated to be fully forthcoming by committing to the highest possible level of disclosure to lower its cost of capital. However, empirical research documents mixed results concerning the relation between voluntary disclosures and cost of capital. Most prior studies suggest that greater voluntary disclosure should lower information asymmetry and therefore reduce cost of capital. Other research argues, however, that increasing cost of capital effects may occur if the disclosures themselves lead to a more asymmetric information environment than would exist in their absence. So, several studies identify a number of firm-specific costs disclosure, such as risk sharing, agency costs, and proprietary costs. So these costs offset the cost of capital benefit from disclosure and influence a firm to be less than fully forthcoming. One of the previous studies mentioned in the paper model a setting where more expansive disclosures lead to a greater incentive on the part of investors to acquire private information, so possibly to get ahead of other investors, resulting in greater information asymmetry and by implication a higher cost of capital. A study by Zhang found that the relation between cost of capital and voluntary disclosure may be positive or negative depending on what causes a variation in disclosure levels. So it can be positive if the variation in disclosure is driven by earnings variability, variability of liquidity shocks, or the cost of information analysis. And it can also be negative when variation in disclosure is driven by disclosure costs, as mentioned earlier. A Botosan's study in 1997 finds a negative association between self-constructed disclosure score used and the cost of equity capital for companies with low analyst following. And Geitzman in Ireland identify a negative relation between voluntary disclosure and the cost of equity capital for firms making aggressive accounting policy choices. In terms of earnings quality, firm disclosure and cost of capital A critical element of the disclosure literature is that voluntary disclosure is a response to information asymmetry. Regardless of the sign of this relation, models characterize voluntary disclosure as responding to the construct of information quality. So the authors expect that earnings quality has a first-order effect or direct relation on the cost of capital, with poor earnings quality leading to a high cost of capital, and disclosure having a second-order effect or a consequence of the first order. So under the complementary relation, if disclosure complements earnings quality, better earnings quality would lead to more expansive disclosures and show a negative relation between voluntary disclosure and cost of capital. Under substitutive relation, when issued to substitute for poor earnings quality, voluntary disclosures should reduce the cost of capital because such disclosures should lower information asymmetry among capital market participants. However, in the absence of control variables for earnings quality, the relationship between disclosure and cost of capital may appear positive in line with the first order effect of lower earnings leading to higher cost of capital. So hence, the authors introduce control variables in order to test hypothesis 2.
Thank you, Ali. Prior to testing the relationship, variables needed to conduct the test were determined and outlined. For voluntary disclosure or VOLDISC, the authors used a proxy in the form of a self-constructed measure, which related literature has suggested to have increased confidence due to the measure being calculable, specific to each firm, free of external bias, inclusive of different types of disclosures, and built on measures from earlier studies. The proxy is a coded disclosure index of financial information from firms' annual reports and 10K filings that include elements pertaining to background information, historical results, key non-financial statistics, forecasted information, and management discussion and analysis. The authors made two modifications, however, from earlier works by Moto-san. First, the authors focused only on voluntary disclosure categories and elements, not including non-voluntary reporting, as they are constrained by regulators like the SEC. This decision increases the power of authors' disclosure proxy to capture voluntary disclosure and ability to detect the cost of capital effects if they exist. And secondly, the authors expand the set of disclosures by adding a category called other financial measures, referring to free cash flows, return on investment, and residual income. So through a refined process, the authors came up with a binary score of 0 or 1 for each of the 25 elements and then are summed up per firm. For earnings quality, the authors use 4 different measures: accruals quality or AQ, earnings variability or EARN-VAR, absolute abnormal accruals or AA, and a combined measure based on the common factor score from the 3 previous metrics or CF EARN-QUAL. The accruals quality AQ measure is based on an earlier model by McNichols, DeChao, and Dishev, which separates accruals based on their association with cash flows by regressing working capital accounts on cash from operations in the current period, prior period, and future period, as well as a change in revenues and property, plant, and equipment. So this data required 11 years of data from 1991 to 2001. This equation yields a series of firm and year-specific residuals, which form the basis for the accruals quality. Its standard deviation is then taken, and those with larger standard deviations is indicative of poorer accruals quality. The earnings variability or EARN-VAR measure is just the standard deviation of a firm's earnings from 1992 to 2001. Earnings is defined as earnings before extraordinary items scaled by total assets. Higher values of EARN-VAR indicate poorer earnings quality. The absolute abnormal accruals measure is just a modification of an earlier model by Jones in 1991. This is a cross-sectional regression for each of the Fama and French 48 industry groups with at least 20 firms in year T. The result of this equation, industry and year-specific parameter estimates are then used to estimate firm-specific normal accruals as a percentage of lagged total assets using the equation at the lower right corner of the screen. The last earnings measure is the common factor score from the previous metric, CF EARN-QUAL. Larger values of this CF EARN-QUAL indicate poorer earnings quality. So all 4 earnings quality measures use a multi-year period of 1992 to 2001 to enhance the construct validity. For cost of capital, the author's main proxy, C of E, for each firm is an implied cost of equity estimate derived from value line data on analysts' 4-year out price targets, dividend forecasts, and dividend growth rates using the expression on screen. The authors used this method because it was also used in earlier works by Brav, Levy, and Micheli in 2005, Francis et al. In 2004, and Botosan and Plumley in 2002. The authors used this also because literature shows that this measure has higher construct validity than other implied cost of capital measures. The authors recognize, however, that despite their preference, there is no consensus on the best measure for cost of capital. For the sample and variable description of the study, the authors used data from 677 firms with data on beta, size, book-to-market ratio, analyst following, number of segments in which the firm operates, and firm performance. Each of the 677 firms' annual reports and 10K filings were read and coded into the test variables described earlier into the table on screen. Some initial insights about the data from the sample variables. Number one, there is a substantial variation in volume of disclosures in 3 out of 4 categories. The one category had majority of firms without disclosures. Number two, for the proxies of earnings quality, each measure saw high standard deviations compared to the mean values. For AQ, this is suggestive of substantial cross-sectional variation. For EarnVar and AA, this indicates non-trivial within sample cross-sectional variation in earnings quality. Number three, correlations between measures is substantial, ranging from 50 to 77% at the 0.0001 significance level. Number four, the CF Earn Qual has an 80% or higher correlation with its underlying metrics and is significant at the 0.0001 level, and therefore is meaningful as a representation of the 3 underlying earnings quality proxies. Number five, the earnings quality metrics are well explained by known determinants, which indicates that each proxy performs well at capturing earnings quality. Number six, the sample mean cost of equity value of 16.6% is similar to other studies such as Botosan's 20.1% and Francis et al. 16.6%. For the author's empirical work and test results, I turn you over back to Ali.
In the discussion of the empirical work and findings, we first discussed whether there is a complementary relation or a substitutive relation between firms' earnings quality and voluntary disclosures. Then take a look at the findings of the relationship between voluntary disclosures and cost of capital. And finally, analyze the components of all this, the variable used by the authors to measure the level of voluntary disclosure. Test of the relationship between voluntary disclosures and earnings quality is shown on panel A of table 3. So all earnings quality metrics exhibit significant positive associations with VOLDIS and CF Earn Qual having the largest magnitude. So this indicates that the relation is complementary in nature, consistent with hypothesis 1A, or firms with poor earnings quality issue fewer disclosures. In panel B of table 2, results show that the complementary result found in panel A is unaffected by the inclusion of firm-specific control variables. So all measures of earnings quality remain significantly positively related to VOLDIS. Results of a regression excluding earnings quality as reported in column labeled base model in panel B of table 2 show that firm size, book-to-market ratio, and to a lesser extent, number of segments and analyst following are significant in explaining VOLDIS. The authors examined the sensitivity of these results to 2 industry-adjusted factors to capture potential differences in voluntary disclosure practice across industries using industry-adjusted scores. So results based on industry-adjusted VOLDIS are similar in all respects to results based on the original variable VOLDIS. The complementary relation between VOLDIS and earnings quality has implications for interpreting the cost of capital effects of voluntary disclosure. Firms with the most expansive voluntary disclosures are also those with the best earnings quality, is consistent with the view that a lower cost of capital for firms with high levels of voluntary disclosure may not be driven by these firms' disclosure choices, but rather is driven by the firms having better earnings quality. So the conditional tests show that when both VOLDIS and CF Earn Qual are included In the regression, all this is no longer significant in explaining cost of capital. Further, poor earnings quality has a substantially larger effect on the cost of equity than does poor disclosure. Specifically, the coefficient estimates of CF earn qual are highly significant, with the magnitude of the DESA-rank coefficient suggesting 6.66% the difference in cost of equity between the poorest and best earnings quality firms. So together with the complementary relation between Volvis and CF earn qual documented in Table 3, these results suggest that discounted cost of equity for high disclosure firms is not driven by their disclosure choices, but rather driven by their better earnings quality. However, the results of regressions that exclude other factors known to affect the cost of equity, such as the data, size, and book to market ratio, show a significant unconditional negative relation between cost of capital in Volvis as reported in Table 4. Volvis comprises of information elements in 4 categories. Category 1 is summary of historical results. Category 2 is other financial measures. 3 is non-financial measures, and 4 is projected information. So there is heterogeneity among firms in what type of disclosures they make in their annual filing. So financial measures under category 2 are free cash flow, economic profit, and cost of capital. And the authors note that most firms, or about 85% of those tested, report none of the category 2 items. Firms with good earnings quality primarily make disclosures that are otherwise not easy for investors to infer from other sources. So category 1 elements are available and readily calculable by investors, such as sales revenues or net income, whereas category 2, 3, and 4 represent information that are not easily discernible from other sources. So the authors expect that category 1 disclosures convey the least information and therefore have the smallest cost of capital effect. And lastly, it is precisely these difficult to discern disclosures that drive the significant cost of equity effect found in the unconditional tests as discussed earlier. So with that, I now turn it over to Marco for the discussion of the conclusion.
Thanks, Ali. To summarize, using the data gathered, processed, and coded, together with the tests conducted, the authors have come to the following conclusions. Number 1, there is a significant complementary relationship between voluntary disclosures and earnings quality. This means that firms with better earnings quality have more voluntary disclosures, and firms with poor earnings quality have fewer voluntary disclosures. This highlights the role of earnings quality in influencing voluntary disclosure decisions by firm managers. Number 2, the authors have found a significant negative relationship between voluntary disclosure and proxies for the cost of capital unconditional on earnings quality. So given the complementary relationship between voluntary disclosures and earnings quality, the cost of capital effect for voluntary disclosure is substantially reduced or disappears completely when it is conditioned on earnings quality or the CF earn qual measure. This means that lower cost of capital for firms is driven by firms having higher earnings quality and not by firms having higher voluntary disclosures. In the same way, firms with poor earnings quality will have a substantially larger effect on the cost of capital than poor disclosure. Number 3, the results are robust for earnings quality and cost of capital, but are sensitive to proxies used for voluntary disclosures. This means that if alternative measures of earnings quality and cost of capital are used, the findings will be consistent. But that is not the case for voluntary disclosures. This is so because the types of voluntary disclosures differ. There's the management forecasts, conference calls, press releases, etc. So whether due to test design construct flaws or difference in sample size, this idea provides an opportunity for further studies. So from Ali and myself, thank you very much for listening and good evening.
Okay, thank you to the two of you for that report. Sige, may question ba yung class? I mean, you can ask questions if you want to. Before I ask my questions, kayo muna. Walang tanong? Sige, I'll start na lang muna with a few questions. Okay, number one. What is the Philippine application of this study? Do you think this study, if replicated in the Philippines, would have the same kind of result? I mean, we're always interested in how we think these studies are going to be impacted, or how can they be transplanted, quote unquote, to our market. No, I mean to our own developing country environment. Do you think the results of this study can be comparable to the Philippine context?
Yes, sir. Thank you for the question. To qualify our answer, no, in our presentation, we concluded by saying that the authors um, have said that the relationship is complementary. So, mas yung earnings quality, mas mababa yung, mas mataas yung voluntary disclosures. In the same way, kung mas mataas yung earnings quality, mas mababa yung cost of capital. That's the author's conclusion. I think here in the Philippines, sir, it's more substitutive than complementary. And for the simple reason that based on experience and based on what we see sa markets, information asymmetry is high. Whether it's because market participants don't take the time to read disclosures, or they just keep on looking for analyst recommendations. I think that the results, if run here in the Philippines, will yield will show differently. No? So if study were to be applied here in the Philippines, I think it will show that that the that poor earnings quality will yield more voluntary disclosures, meaning it's substitutive. And I think that more voluntary disclosures naman will also yield into a lower cost of capital. Unlike what the authors provided, they said that walang masyadong kinalaman yung number of voluntary disclosures sa cost of capital.
Essentially, what they said was what they said in the study was that voluntary disclosures has an impact on earnings quality, but voluntary disclosures, pag isinama mo na siya sa determinant ng cost of capital, nawawala na siya. Right? I mean, it's not significant based on your report, right? So therefore, hindi siya determinant ng cost of capital, but it drives earnings quality. Right? Parang ganun yung sinasabi. Can you explain further what substitutive means? And then what is the theory behind substitutive, so that we can understand whether it's really applicable in the Philippines? I think you have a slide on that, right? When you say substitutive, ganito ibig sabihin nun, and the theory behind it is this one. So probably you can show that, then we can discuss it further.
Yes, sir, I'll just share my screen again.
Yung complementary, ito. Okay. So firms with poor earnings quality will issue more expansive disclosure. So substitutive, so it's either good earnings quality but no disclosure, or good disclosure but poor earnings quality. That's what substitutive means. Complementary is good earnings quality will issue more expansive disclosures. Ibig sabihin, kung magandang earnings quality mo, and I'm sure you know what earnings quality means. Ano ibig sabihin ng earnings quality, right? I'm sure you discussed it in your 219 class. No? So earnings quality, because you know that there are a lot of estimates in earnings, and there are also some room for quote unquote manipulation for earnings disclosures. And so high earnings quality means nagko-correspond more or less to cash flows yung earnings. There are less accruals, there are less provisions, no? And what you see as net income, para siyang performance talaga on a cash flow basis, more or less it approximates. Parang ganun yung what's meant by earnings quality. And the idea is when there is high earnings quality, there is less information asymmetry, right? And with less information asymmetry, it influences the assessment of risk of investors, right? If earnings quality is high, therefore mas nagiging attune siya kung ano yung information na nakukuha niya, and therefore yung risk na ascribe niya into the company will be lower, and therefore his pricing of risk will also be lower, and therefore it results to a lower cost of capital. No? So parang that's the theoretical foundation. Of course, you can always debunk that by saying that the risks that we are talking about here, these are all diversifiable risks, right? Because at the end of the day, when you compare on a market basis, nandoon yun ang basis ng cost of capital on a WACC basis, right? I mean, pag beta na pinag-usapan, buong market na yun, and not concerning individual earnings quality on the firm level, right? Diversifiable na yun on a macro perspective. So, but that's on a macro theoretical standpoint, but in reality, in the decisions of individual investors, earnings quality may impact their assessment of the cost of capital. Okay? Kasi at the end of the day, the economic foundation of the cost of capital, or CAPM, the economic foundation of CAPM, is based on rational expectations, based on rational investors or rational individuals. Okay, earnings quality might lead to information asymmetry, which is a market failure, right? Which makes the CAPM not a perfect way to determine the cost of capital, right? So, kumbaga, if you work in firms, for example, I've worked in several firms. There are several firms na ang basis of determination ng cost of capital ganito, magka-CAPM muna. After mag-CAPM, parang pangit yung due diligence natin sa project na yan. We should probably put an adjustment, no, related to poor information. So that's the decision of the individual investor, and that's not part of general market consensus of what the CAPM should be or what the cost of capital should be. But information asymmetry it becomes a market failure, which makes CAPM not a perfect way to measure the cost of capital. Can you go down in your presentation sa substitutive? Yan, slide na yan. Okay. So, substitutive, the main principle behind substitutive is there. Information asymmetry, specifically between what? Between insiders and shareholders. Shareholders meaning, kasi insiders, ang definition ng insider based on our previous lessons also. Insider is shareholders who are management also, or board of directors who are also shareholders. They are insiders in the company. They know inside information about the company. No, shareholders naman, nasa labas yan ng corporation. Right? So they do not know insider information. Okay? So because of that information asymmetry, there's a demand from shareholders, yung mga outsiders, they demand disclosure. Okay? If a company has poor earnings quality, the demand for those disclosures will increase. Right? The shareholders will be more demanding of information if the earnings quality is low. Right? And therefore, that increases the propensity of these companies to provide more disclosures. Okay? So yun essentially ang theoretical underpinning ng substitutive relationship between earnings quality and disclosures. Okay? Now, yung complementary naman, okay, so here, I think what I'd like to highlight here is, nasa na ba yun? So the first bullet point is, as information quality increases, no, managers have incentive to disclose more. Okay? So ang theory behind complementary is the theory of incentives, right? if the information quality or earnings quality is high, no, managers have incentives to disclose more, no, and so that's the main theory behind complementary. Okay, if you look at cost of capital and voluntary disclosures, the next slide. Okay, there's a portion there. Ayun, the third bullet. That's what I want you to understand, no? Kasi kung tutuusin, voluntary disclosures should decrease a lot of costs related to the company and basically agency cost, right? And if you increase disclosures, agency cost decreases, no, therefore risk decreases, cost of capital decreases. But there are others, no, based on the study by Diamond, that third bullet, okay? So risk sharing, agency cost, and proprietary costs, because disclosure has has costs aside from agency cost, no? Or even if there's a reduction in agency cost, merong proprietary cost. Ano yung proprietary cost? Proprietary costs are costs kasi you disclose too much, and therefore there could be higher competition because of your disclosure, right? Or your regulator suddenly got wind of what you are going to do and they cut you. No, merong new regulations kasi nakita sa disclosure mo that you are taking advantage of some other loophole, regulatory loophole. So those are called proprietary costs, and they offset the benefit of having less information asymmetry. So that's why unclear then what's the impact of voluntary disclosures, because disclosures may reduce asymmetry but increase other costs. So meron din siyang parang equilibrium level. And that's what we discussed here. Okay. So given that this is the theory behind substitutive, okay, do you think it has a significant impact in the Philippine setting? So in the Philippines, we're not very fond of disclosures. Okay. I don't have any empirical study, and probably those working in the sector might have more opinion about it or have more grounded opinion than me. No, based on the companies that I've worked for before, disclosure is not, you disclose at the minimum, whatever is required. So there's no voluntary additional disclosure unless it's good news, right? You usually don't volunteer bad news disclosures ahead of time. So therefore, news are biased towards, or voluntary disclosures might be biased towards good news, which makes the value of voluntary disclosures diluted. Right? Parang baka hindi ka rin maniwala agad, palagi naman positive yung voluntary disclosure. So that could impact that could dilute the agency cost reduction, or information asymmetry cost reduction power of voluntary disclosures. Okay. One thing that needs to be studied in the Philippine setting is earnings quality versus cost of capital. Kasi this is two-step voluntary earnings to earnings quality to cost of capital. That was the findings of this study. But in the Philippines, earnings quality and cost of capital has not been proven yet that shareholders or providers of capital reward companies with high earnings quality by having a lower cost of capital or lower required rate of return on their provision of capital. So that step has not been proven yet. No, so I think that's something that complicates the Philippine setting. Okay. Any other responses from the group?
Just to add to that last point you made, sir, no, I think also in the Philippines, kasi the bigger the company or the bigger the firm size, the more people they have to prepare the reports and to disclose. So I think that
Yes.
if you're an Ayala or an SM group or any of the conglomerates, then um, information asymmetry in our view is much lower than in a smaller, maybe secondary or a non-blue chip stock. So aside
Mhm.
from that, the sample size for such a study might not yield overall significant results because medyo bilang naman sir yung companies dito. There are only about 200 plus companies in the Philippines, whereas the study made here, there were 677. So
Mhm.
so I think to that point, it will really show that the smaller firms who disclose less may actually have a larger cost of capital than larger firms who disclose more. But also on that point you made earlier, sir, about firms not being proactive in disclosing negative news. Madalas they issue a response to an article or issue a response.
Mhm. That's right. Pero
Uh,
isn't that required? Hindi ba required yun?
the language, sir, in the disclosures always say in response to, but it's not as if the exchange is asking them to all the time to make a clarification.
Mm.
There's a clarification most of the time, but sometimes it's just a voluntary disclosure. I
Okay.
think the motivation is to protect the share price, to prevent it from, of course,
Correct.
being traded lower. No? So I think just to qualify our answer once again, I think information asymmetry here in the Philippines is higher than in the case where the authors did their test. So I think it would be more substitutive here in the Philippines rather than complementary. I think si Ali would also um, agree with that, sir.
Okay. Any other thoughts from the class or anyone else? I think that's all I want to discuss. To make sure that we are grounded on the theory behind this study. Because in reality, when you, for example, when you borrow, and you undergo the process of due diligence by your lenders, you will really see there that there is significant push by your providers of capital to voluntarily disclose. Okay, I mean I've discussed a lot of loans with banks and closed some loans on the corporate basis. And disclosure is something that they appreciate. And disclosure is um, something that they appreciate, and it reflects on, of course, I don't have empirical basis to say that it reflects on the actual cost of debt that we closed, right? But I believe so. I mean, kasi yung long-term, yung long-term asset liability management of a corporation, that is also a function of long-term relationships with banks and with financial institutions. So there are some loans which, I mean, we've closed some loans na kung ako yung magpapautang, alam kong hindi ko pa utangin. But because of relationship, because of constant experiences before, that there were trust, between the bank and the corporate, no, gagawin ng paraan na nabibigyan ng loan at a certain price. No? Kasi voluntary disclosures also provide trust, in the whole fundraising process. So I think that also contributes to it. Of course, I'm thinking about the micro basis, meaning one transaction, but I'm sure on a macro basis, banks also prefer, or banks also value disclosures in terms of their transactions with different corporate borrowers. Okay. Right. If there are no other questions, let's proceed to the next one. Thank you.
Thank you,
Yung
sir.
next one, maikli lang yun dapat. Like it's a 4-page paper. Pero medyo mas technical ng konti. Sige. Who's sharing the presentation for the last?
I'll share my screen.
Okay.
Good evening, sir and classmates. I, together with Claire, will discuss and explore the relationship between the weighted average cost of capital or WACC and the marginal cost of capital or MCC. The following will be the flow of our discussion. To start, WACC is defined as the blended cost of the firm's sources of capital, such as debt, common equity, preferred stock, etc., wherein the cost of capital are measured as a percentage of annual costs to the net proceeds. In calculating WACC, it is important that all sources of capital are incorporated so as to properly guide the firm in terms of its investing and financing decisions. In essence, WACC reflects the overall required return of the firm. To visualize, presented in the slide is a diagram wherein WACC is presented as a traditional U-shaped figure. In the diagram, WACC is graphed against the firm's debt to assets ratio in the x-axis to reflect the firm's capital structure. The minimum point on the WACC curve is known as the firm's optimal capital structure. Moving forward, the marginal cost of capital or MCC is defined as the cost of obtaining new funds for the firm. In general, MCC is higher than a WACC as MCC refers to an increase in the financing costs as a result of getting additional funding from external sources such as the capital markets. Moreover, MCC increases as the total amount of funding increases due to the additional risk such as additional debt financing on top of the firm's current debt. To visualize, presented in the slide is a diagram wherein MCC is graphed on a stair-step basis against the total new capital raised by the firm. The stair steps represents the breakpoints, which reflects the jump in the cost of capital due to the exhaustion of the cheaper sources of funding. However, in our report, instead of looking at WACC and MCC separately, we'd like to highlight the relationship between WACC and MCC. To guide us, presented in the slide is a diagram containing both the WACC and MCC. As shown in the diagram, the minimum point on the WACC curve represents the firm's optimal capital structure. Moreover, it also defines the first step of the marginal cost of capital schedule. In the diagram, the stair steps of the MCC schedule reflects the path of the minimum point of the WACC curve along the total new capital axis. This simply means that as the firm encounters higher marginal cost of funding at the breakpoint, the weighted average cost of capital shifts upward from WACC 1 to WACC 2. As a result, the minimum point on the WACC 2 curve represents the next step on the marginal cost of capital schedule. To put it simply, the WACC curve rises as a result of the firm encountering higher costs associated with raising larger amounts of new funding. Furthermore, it should be noted that any further upward shifts in the WACC curve due to the additional jumps in the cost of debt or equity or both will result in additional steps to the MCC schedule. Aside from this, it is also important to note that the WACC curve shifts upward vertically, and as a result, the firm retains its original capital structure. Should there be any changes in the curvature of the WACC at breakpoint, this would result to a new capital structure of the firm on top of an increasing MCC. To appreciate further the relationship of WACC and MCC, I now turn you over to Claire.
Thank you, Heidi. Now, the other way of presenting the relationship between WACC and MCC is through a three-dimensional diagram. WACC in here is represented by the curved plane with respect to the total new capital axis. The same concepts apply from the previous discussion, where the minimum point of WACC 1 defines the first step in the MCC schedule for the MCC1. At the breakpoint, WACC will move upward to WACC2, and this will be the next step in the MCC schedule. To illustrate better the concept, here's an example. A firm is contemplating a new investment of 5 million pesos that has an internal rate of return that exceeds its cost of capital of 10.4% with the following details. Currently, the firm has available funds composed of debt of 1.2 million pesos, having an 8% cost, and equity of 1.8 million pesos, which has a cost of 12%. The firm can raise unlimited additional funds through debt at 10% and equity at 15%. Also, the firm plans to maintain its current capital structure, which is 40 to 60. WACC1 is 10.4%, and this is the current cost of capital of the firm computed from the currently available funds, which is comprised of 1.2 million debt and 1.8 million equity and their respective costs. MCC1 will also be 10.4%. For the computation of MCC2, it is based on the additional cost of debt of 10% and equity of 15% multiplied by their weights, which is 40 to 60, or the current capital structure which the firm plans to maintain. And lastly, WACC2 is derived by multiplying WACC1 and MCC2 by their weights. For instance, 3/5 is from 3 million current funds divided by the total capital needed for the investment, which is 5 million. Afterwards, we will be plotting the computed cost of capital in a two-dimensional diagram, and it will look like this. As discussed by Heidi earlier, MCC2 is higher than WACC2 due to the increase of costs in obtaining additional funds. The previous discussions revolve around maintaining the current capital structure of a specific company, which is not always the case in the actual scenario. Should the firm's capital structure changes after obtaining additional financing, it would result the WACC curve not just moving upwards, but also moving to the right or left, as the minimum point of the WACC curve would be shifted in either direction as a result of the change in the curvature of WACC. The change in the curvature of the WACC thereby reflects the change in the optimal capital structure of the firm on top of higher cost of capital due to acquisition of additional funding. In this graph, it is assumed that the debt ratio will increase. Thus, the WACC curve moves vertically to the right. To recap, if a firm maintains its current capital structure after obtaining additional financing, the WACC curve will only increase vertically. The path followed by the minimum point of the WACC curve along the total new capital axis defines the MCC schedule. And lastly, the weighted average cost of capital is equal to the marginal cost of capital. No additional financing is needed. That's the end of our presentation. Once again, good evening, everyone, and thank you for listening.
Okay, thank you. Can you share the PowerPoint? And let's discuss this further. Sige, let's go to your last slide, yung summary. So that we go with the end in mind muna.
Ay, shucks.
Sir, sorry.
Okay lang.
Ay, sir, nakita na ba yung screen?
Hindi. Nakikita yung folder na recents.
Oops. Stop share.
Yan.
Okay.
Let's go to the last slide para yung key points muna. So the last slide there is essentially what this article wants to do, no, is to provide an economic foundation on the WAC and the MCC. How are they related? Okay. So the first key point there is that if the firm retains its current capital structure but needs additional funding, no, the WAC curve will only increase vertically. Can we go to the WAC curve? Para ma-explain natin yan. Okay. When will it increase vertically? Teka, I'll go to... So here, what's being discussed is, pag nag-increase daw na ganyan, dahil daw saan? Uy. Sagutin niyo
Sir,
ako.
when... Ay. WACC shifts upwards, sir, as a result of higher cost of capital due to additional when they acquire new funding for MCC. So parang at a certain break point,
Correct.
nag-shift siya pataas kasi yun nga, most of the cases parang if you want to acquire an additional funding, you can't actually get it at the same cost as you currently have now. So if you want to fund additional projects, you have to bear the additional cost.
Okay, so bear the additional cost because of the higher cost of capital. So this assumes that the cost of incremental funding is higher than the current funding, right?
Yes.
So that the curve will shift upwards. Okay, and that's one assumption. What's the other assumption? The capital structure will not change.
Yes, because I'm sorry.
Right? Because you are at the same capital, at the same debt to asset ratio. So
Yes,
kumbaga,
because-
nag-raise ka ng funding at the same weights, right? So therefore, it should be directly above it. No, I mean there's no shifting left or right, up or down lang, right? So therefore, this is due to an increase in cost of funding, essentially, due to the incremental cost of funding, right? And this one actually does not fully explain. Oops, ayaw mabura. Sorry. Can you unshare and then share again?
Sige, sir, wait lang po.
Kasi minsan hindi siya nabubura. Yan. Okay.
Sir, okay.
Okay.
Ay, sir,
Alright.
nakita mo yung screen.
Yeah. Can you go to the 3D na? To the two.
Sir. Eto.
Okay. So here, ito yung original, no? And this is what you see at the cost of capital DA plane, right? Pero here we put total new capital. So these are all incremental capital, right? And this incremental capital has a certain cost, right? Ngayon, yung plane na to, okay, yung plane, yung curvature na yan, okay, yan ba ay lahat, yan ba ay parallel to this one? Can you imagine what I'm asking? Kasi 'di ba noong cost of capital DA plane ganyan itsura niya, 'di ba? CCDA, two dimension lang at the same DA. Right? Okay. Ngayon, nung kinuha ko na, pag kinap ko siya sa plane na to, dyan sa plane na yan, anong itsura niyan? Ito na siya, di ba? Pag kinap ko siya dito, correct? So parang, you'll imagine, dapat pala hindi red ginamit ko. Teka. You'll imagine, ito siya, di ba? Okay. So when you cut it at that perspective, no, then doon lalabas yung kanina na MCC. Right? Na ganyan. Right? New capital. Sorry, dito pala yung new capital. New capital, which is this axis, cost of capital, which is this axis. So kung doon mo siya titingnan from that perspective, lilitaw doon yung MCC relationship with the WACC relationship. Okay? So yun ang ating perspective here. Anything else? Anything that you'd like to add? Can you go to the last slide again for the other key points? So yun na nga, the path followed by the minimum point along the WACC curve along the total new capital axis defines the MCC schedule. So that's what I discussed. No? You had a graph where so just to again emphasize, if there's a change in the weights, so WACC 1, WACC 2, if there's a change in the weights, so it can be the case that there's not an upward or downward shift, but also including a left or right shift, with respect to the WACC curve. And this represents a change from DA star to DA1, a change in the capital structure or the optimal capital structure of the company. Okay. Although in this perspective, there was a change in DA and DE, but from a 3D perspective, okay, ganun pa rin siya. It's the same ladder. Kasi the shift is left and right. Walang left and right dun sa plane na yun. Right? When you project it against that plane, it's only the breakpoints, and the line and the marginal cost of capital and new funding. Okay? So essentially, yun yung parang graphical representation niya. So yun lang what I wanted to discuss here. Any questions, clarifications? Wala?
Sure,
Sure kayo?
question.
Yeah, sure.
How can we apply that concept, sir, sa work?
Hindi, wala. Hindi siya pang work. I mean, this is
Okay.
the economic, this is the parang, I guess, kasi in the lesson, when I looked at it, there's no, actually, practical yung lesson. That's what you do in the workplace. Yung lesson natin on, yung video, no? That's exactly how you do it in the workplace, right? So I just wanted to provide a little bit more of in economic rationale behind it. So ito yung parang, I guess, graph or econ analytics related to the MCC and WAC. Okay.
Okay. Thank you, sir.
Okay. All right. So if there's none, let's proceed to the next one. Let's do the case na para maaga tayo matapos. So let's proceed to the case. Who will show it for the last group?
Sir, me po. Let me share my screen now po.
Sige.
Sorry, wait lang po.
Good evening, Professor Velasco. Good evening, classmates. Tonight, Jess, Luis, Lynn, Lorraine, and I will discuss the case entitled Cost of Capital at Ameritrade. This is going to be the outline of our presentation. First, we'll introduce the case through a thesis statement. Then we'll discuss the background of the company as well as the issues to be addressed. Afterwards, we will present our analysis and conclude with a recommendation. Let me start the discussion by presenting the main problem which we aim to address. In relation to the chairman and CEO of Ameritrade Holding Corporation, Joe Ricketts' plan of growing the company's revenues, what is the appropriate cost of capital to be used in evaluating its upcoming investments? To guide us in answering this question, let's first go through a brief background of the company. Ameritrade Holding Corporation was formed in 1971 and has been a pioneer in the deep discount brokerage sector. A firm operating in this sector offers to execute equity and fixed income trades at minimal costs, even lower than those offered by a traditional discount broker. Ameritrade was the first to offer many services which leverage technology to make investing easier, faster, and more efficient. It was the first company to offer an automated touch-tone phone trading in 1988. Through its acquisition of KF Hauser and Company in 1995, which was credited for the execution of the first online trade in 1994, Ameritrade was also the first company to offer the online internet trading. It was also the first company to offer a personal digital assistant to access trades and an online program investing for individual investors in 1995 and 1996, respectively. The company was known to have a high average return on equity. During 1975 to 1996, it recorded an ROE of 40%, with only 2 years out of the 21-year period posting a negative ROE. Finally, in March 1997, the company went public through an initial public offering and was listed in the Nasdaq exchange. It was able to raise $22.5 million, which will allow the company first to continue adopting to the latest advances in technology, second, to build its brand through increased advertisements, and third, to improve its market share. Some of the known competitors of Ameritrade are Charles Schwab and E-Trade. Let me now turn you over to Luis for the discussion of Ameritrade's revenue sources, key financial statement items and ratios, and its investment plans.
Thanks, Lou. Now we proceed to the revenue sources of Ameritrade. Ameritrade has two primary sources of its revenues: transaction revenues and interest revenues. From 1995 to 1997, transaction revenues provided the largest chunk of revenues, which came from brokerage commissions, clearing fees, and order flow payment, which are cash payments received by Ameritrade for routing orders to execution agents. Interest revenues, on the other hand, are interest income from debt balances in brokerage accounts and short-term marketable securities, which are segregated in compliance with federal regulations. Interest payments to customers is deducted to arrive at the net interest. Now we proceed to Ameritrade's balance sheet accounts. Bulk of its assets are receivables from customers and correspondents, as well as segregated cash and investments due to financial regulations. Cash and cash equivalents amounted to around $53.5 million in 1997 and $15.6 million in 1996. Consequently, payable to customers and correspondents got the lion's share in liabilities. By 1997, Ameritrade has no more payable to bank. And for equity, retained earnings and additional paid-in capital comprise most of it. Retained earnings is at $43.5 million in 1997. On a ratio basis, Ameritrade is considered to be liquid, with current ratio of greater than 1 for 1996 to 1997, and debt ratio is 0 for 1997 since the company has no more bank debt. Return on assets decreased due to increase in assets, which almost doubled in 1997 from 1996, while the decrease in return on equity was due to Ameritrade's initial public offering in 1997, wherein it was able to raise $22.5 million. Nevertheless, return on equity is high at 20.63%. From what we have seen in its revenues and assets, Ameritrade is growing, and its CEO communicated no signs of stopping. He envisioned the company to be the largest brokerage firm worldwide based on the number of trades by targeting self-directed investors. To be able to achieve this, Ameritrade must do price cutting, which would reduce commissions for all internet market orders from $39.95 to $8 per trade, since customers were price sensitive. In support of it, technology enhancements should be done to increase trade execution speed, which is budgeted at $100 million. He also planned to raise advertising budget to $155 million for the next 2 years in its attempt to increase market share by being a low-cost provider of online brokerage services. Since the plan involves investing heavily on technology, there arises the question of which type of business Ameritrade is in, whether it is still a discount brokerage firm or a technology internet firm. Also, to be able to execute it, an assessment of its financial impact and risk is needed. Based on its available cash and project budget, it can be clearly seen that Ameritrade needs external funding, which would entail capital cost and possible change in the company's capital structure. These issues will be addressed in the next slides as we proceed to our analysis.
Thanks for that, Luis. We now proceed with our analysis. These are the contents of our analysis. Number 1 and 2 will be discussed by me, and then Lorraine will discuss numbers 3 to 5. The first step in our analysis is to find out which among those companies in Exhibit 4 are indeed comparable for purposes of estimating Ameritrade's cost of capital. So we have identified 3 criteria in determining this. First is that they should be in the same line of business, because to be comparable, they should be in the same industry, which is specifically in this case the discount brokerage business. Next is the percentage of revenues. As Ameritrade's revenues are virtually all linked to its brokerage business, then it makes sense that comparable companies' revenues should come substantially from its brokerage business. And then lastly, availability of market data. Because of this, we chose those companies that have available data starting from January of 1992 until December of 1996. So based on our criteria, we have chosen 3 comparable companies from which beta will be computed. These are Charles Schwab, Quick and Riley Group, and the Waterhouse Investor Services. It is important to note, however, that E-Trade, which gets 95% of its revenues from its brokerage business and is in the same industry as Ameritrade and the three comparable companies, was not chosen because it has limited market data since it became a public company only on August of 1996. Also, for Waterhouse Investor Services, data is only available to September of 1996, as it was acquired by Toronto Dominion Bank or TD Bank in the same year. But still, we chose this as part of the comparable companies because there's more than enough data available for the same period. Next is we have to determine the beta. But first, we have to define it. So beta is just the measure of the volatility or the systematic risk of a security or a portfolio to the market as a whole. So in determining the beta, we have to first compute for the monthly return of each stock. Presented on this slide is a sample data from Charles Schwab, which shows the price as well as the dividends and the stock splits if there are any. To compute for the monthly return, we have to divide the net increase or decrease in the price of the stock by last month's price. If there is a dividend, we have to add this to the numerator before dividing it with last month's price. Now, if there's a stock split, like what happened in March of 1995, we have to take this into account by adjusting the previous month's price in order to get the correct net movement in the stock price. So now these are our monthly returns for this sample data. After computing for the monthly returns for each stock, we now proceed to collecting the data for the market return. And based on Exhibit 6 of the case, we had to choose whether it should be devaluated or equal weighted. We eventually decided on the former, using the valuated portfolio was identified as a more appropriate method compared to the equal weighted portfolio because of the identified impact and equivalent importance of the three companies as more representative of calculating for the cost of equity. Then we have to calculate the covariance, which is just the measure of a stock's return relative to that of the market. We can calculate this by simply using the covariance formula in Excel. Next would be to get the market variance for each stock. Notice that Charles Schwab and Quick and Riley both have the same figures for this, simply because both have identical dates covered, which, as mentioned earlier, is from January of 1992 to December of 1996. Waterhouse, on the other hand, has a different market variance from the other two because data is only available until September of 1996, as again previously discussed. Then by dividing the covariance by the market variance, we now have each stock's levered beta. So that's it for me. The next steps will be discussed by Lorraine.
Thank you, Jess. So the derived betas from the previous discussion includes the impact of each company's leverage. To get the beta to be used for Ameritrade, we now have to remove the effect of it. So from our discussion, we will use the formula equity beta divided by the 1 plus 1 minus tax rate multiplied by the DE ratio. To get the DE ratio of each company, we use the average market values from 1992 to 1996 provided in the case. DE ratio for Charles Schwab is at 0.09, 0 for Quick and Riley, and 0.61 for Waterhouse. We also use the applicable corporate tax rate during the period, which is at 35%. Now, resulting asset beta are as follows: Charles Schwab at 2.17, Quick and Riley 2.20, and Waterhouse at 2.28. So we get the average of the three, and it will result in 2.22 asset beta, which will then be used as the beta for Ameritrade. Okay, so from the information provided, we can now calculate Ameritrade's cost of capital using the capital asset pricing method, CAPM. So on the risk-free rate, we apply the 30-year bonds on U.S. government securities as of August 31, 1997. We deem that this is reasonable given that it matches the investment horizon looking at by Ameritrade. Recall that the planned capex is expected to grow the company's customer base, and the company will be expecting returns for the longest period possible. The second component is the beta, which we just calculated to 22. And then for the final component, the market risk premium, we use the recent market return based on the historic average total annual returns on U.S. government securities for the period 1950 to 1996. We use the return applicable for long-term company stocks at 14%, and for the comparable risk-free rate for this return, we use the return on long-term bonds for the same period, which is at 6%. So this will give us a market risk premium of 8%. And then substituting the values to the formula, the cost of capital for Ameritrade is at 24.37%. Okay. So in the previous slide, we were able to calculate the cost of capital assuming zero debt, which equals to the WACC of the company. Now in this slide, we made a sensitivity analysis to check the resulting WACC had the company decided to source debt for its planned capex. So first, we derive the average DE ratio of the comparable companies, and we arrive at 0.35, shown in the fourth column. And we also added a higher limit, DE ratio of 0.67, equivalent to 40% debt ratio, and on the lower limit, 0.25 DE ratio, equivalent to 20% debt ratio. Now, using the range of these target DE ratios, we have to releverage the asset beta to incorporate its effect. So as you can see here, as the DE ratio increases, the beta and the cost of equity also increase. So from 24.37%, it went up to 32.06%. And in order for us to get the WACC, we also estimated the cost of debt. So we used the corporate bond yield for the period based on bonds with maturities of 20 years and above for the period, which is at 7.78%. And we also applied the corporate tax rate of 35%. So the resulting WACC is as follows. So with the lower cost of debt and tax shield, it reduces the WACC from 24.37%, it went down to 21.26% at 0.67 DE ratio. So to summarize, as the company plans to source more debt, its equity holders will demand a higher return as a result of the increase in volatility of its stock represented by the beta. On one hand, the WACC will go down as a result of the lower cost of debt and the benefit from the tax shield. I will now turn you over to Lynn to discuss the group's recommendation.
Thank you, Lorraine. With Joe Ricketts, the CEO, hiring a team of consultants to provide a cost of capital estimate for the company for investments in the future, it was found out that the calculated cost of capital at zero debt is significantly higher than that of the current estimates. While unlevered WACC is 24.37%, CS First Boston, Ameritrade CFO, and its managers apply a discount rate ranging between 8% to 15%. It is recommended to increase debt, which will reduce cost of capital to finance upcoming projects. Depending on the decision on the change of capital structure or the lack thereof, the cost of capital will range between 21% and 24%. Ameritrade should take advantage of the improvement of cost of capital as debt increases. However, funding through debt should be delimited to an extent. As debt increases, beta also increases, affecting the cost of equity, which usually has a higher rate than the cost of debt. On top of that, as debt approaches less than optimal levels, Ameritrade will need to pay a higher cost of debt, so limiting debt is indeed necessary to achieving acceptable levels of cost of capital. To understand the limit that should be set, one benchmarking method is to compare the company's capital structure with its peers, represented by Quick & Riley at no debt, Charles Schwab at 8% debt, and Waterhouse at 38% debt. Rounding off values, debt ratio has been identified to range between 0% to 40% and averaging 26% for leveraged firms. This may be used as a conservative reference for the internal rate of return for the project. With better access to information, such a range of funding options would be narrowed down by how the management would be able to handle debt resulting in a change in capital structure. Should the company choose to stay debt-free, it will need to issue more equity through a follow-on offering and the like, wherein the cost of capital is at 24.37%. Should the company choose to restructure permanently, it might still need to issue more equity, but the introduction of debt will improve the cost of capital to 21.26%. Applying that to its current proposal, management aims to invest $255 million on technological enhancements and advertising budget. These initiatives appear to affect the company in the long term to stay ahead in terms of innovations, as well as maintain its customer engagement. With cost of capital representing the company's internal rate of return, projections of various stakeholders result in a wide spectrum of values. The CEO's expectations are likely aggressive, with returns between 30 to 50%, thereby resulting in a likelihood of the project being approved. Whereas managers are not nearly as optimistic at 10 to 15%, which can also be a sign of sandbagging their targets. Regardless, the varied expected return will result in the IRR being down to the middle of the two extreme ranges. So reevaluating the project's expectations will narrow down the decision to whether to proceed with the project or not. It is recommended to assess the likelihood of both conservative and optimistic estimates by incorporating the project's probabilities and risks. In conclusion, the team recommends to reassess projects given the gap between conservative and optimistic expectations. Based on the project's probabilities and risk, a point forecast on expected rate of return can be compared to the IRR. Furthermore, looking at comparable companies and assessing the cost of capital, the company has been recognized as a discount brokerage firm based on the nature of the business. This is the ideal method in searching for peers while the company stays closely within its business model. It is recommended for the company to take on long-term debt again to improve its cost of capital. However, borrowing should be capped to realistic levels as cost of debt significantly increases for extreme cases of debt ratio. Ameritrade may once again look into its peers for debt ratio benchmarking. Finally, the team recommends to calibrate investment philosophies for the senior management. To quote the CEO, he intends to maximize shareholder wealth even with bankruptcy, which is not a good sign of good governance. This practice might result in subscribing to asset substitution, among other agency costs, which could be detrimental to the company's sustainability. That's it for the Ameritrade case. Thank you.
Okay, thank you. Thank you to the group. So again, just like before, we'll start with questions from the critic group. So just raise your hand if you want to be recognized, and then I'll recognize you, if you're ready with your questions.
Hi, good evening, everyone. I guess just to start, maybe just a clarification. When you actually the way we did it was quite similar to what you guys did, and our cost of equity and WACC is a little bit similar to ours as well, because you have the same methodology. In the recommendation, I think you guys mentioned that that the firm should finance its capital expenditure through debt or bank loans, and you mentioned also there should be a particular cap for incurring that debt, and you guys advised that or recommended that the company should look into the DE ratios of its peers. I think the highest is 0.38% from I forgot what company that is, but is that also your recommendation? So for Ameritrade to incur debt on its balance sheet up to a maximum of 40%? Just for clarification.
Hi, Daniel. Yes, that's right. So we are recommending to adjust the debt ratio of the company if ever they will need to raise more funds to up to 38%. Sorry, I'm looking for the reference for that. Yeah, and that's coming from Waterhouse, which is up to 38%, yes, of their debt as one of our references. But that, I guess that's a cap, relatively aggressive cap, I guess.
Yeah. Actually, when we look at the peers for the company, I think it's an exhibit 4 of the case. Not a lot of them have that levels to begin with. I think it's just one or two people that have DE ratios that are indicated there in the deep discount industry. And if you look at the financials also of Ameritrade, it has very good profitability. I think it's a pretty great brand, and it might have like a positive, let's say, reputation against its creditors. They have short-term bank loans already, and I was thinking, is 40% a little bit too conservative as well? Is it possible, or would you guys what do you guys think of DE ratios above 40%, given that it's a profitable industry, it has a good brand, and it doesn't have any presence of long-term debt? So I would assume that the cost of that the company will incur on any additional incremental, or sorry, on any incremental long-term financing is going to be lower. Any thoughts on DE ratios above 40%?
Yeah, I think you make a great point on that note. I guess it's because them being sort of long-term debt free for about a year, I guess, and I think rushing the company into subscribing a lot of significant debt soon might not be a good transition for the company. And qualitatively, I guess I'm gonna need to refer to one of my recommendations, one of our recommendations, sorry, which is like some qualitative worries related to the senior management, wherein they might subscribe to asset substitution, and it might not be good also to fund through more debt if that's the mindset of the team. So I guess reduce the cost of to reduce the cost of not being able to be as responsible, I guess, to their creditors. I think I think the company should slowly adjust to taking in more debt.
Okay. Thank you, Lynn. Sorry, it's just coming. Sorry.
Sige, can I comment on that? I think one, there's value to debt in this case, no, and you demonstrated it in what way? If you look at the cost of capital calculations, can you go to that calculation? Yung iba-iba by debt levels, there's a table.
Yes, sir. Here.
Right. Obviously, assuming that the free cash flows will be the same across all of these, nag-iiba lang is debt cash flows, and therefore but based on that, nag-iiba lang yung debt levels, and then the discount rate is obviously being reduced from the base case to 67%. Okay, but one basic assumption here is that the cost of debt remains the same across that spectrum from 0.25 to 0.35 to 0.67. What can be your benchmark of kung kailan mag-hold lang yung 7.78%? It will only hold if you are within the industry's norms, right? Because if your debt to equity ratio will be higher than quote unquote what's the norm in the industry, then this company will now be assessed to have more risks than the industry, and therefore might result in higher cost of debt, which makes this WACC calculation iba na siya when the DE ratio is higher. So how you should interpret this is that there's value to debt as you increase debt, but only to an extent, right? That's what we learned in capital structure theory, right? Only to a certain extent. And that extent is when you have already reached your optimal capital structure, but that optimal is very theoretical, right? But if you look at industries, sometimes industries gravitate towards a common capital structure, right? And therefore, yun yung nakikita on a practical basis, yun yung nakikita na optimal, quote and quote, for the industry. And so therefore, parang yun na yung nagiging benchmark mo. If you go beyond that, no, your cost of debt will likely increase. No, I mean, on the average. If you go below that, then you're a little bit safer than the industry. You can even get cheaper loans. No? Here, in this WACC calculation with this varying cost of varying weights for debt, no, it assumes that the cost of debt is not moving, right? And that's a fundamental assumption, no. And so, going by what Dan mentioned, no, so therefore punta ka sa industry, right? If you look at the industry, the two other players have very low debt to equity ratios, right? That's 0 and 8%, kung tamang alala ko for Charles Schwab. Okay.
Yes, sir.
So, and then this company is 0% also, right?
Yes,
so
sir.
actually, the industry is gravitating towards the lower end of that range. So it's not impossible for us to understand na baka lower end of the range lang yung mas feasible. Okay, because everyone's congregating within 10%, right? I mean, if you look at other discount, yung E-Trade ba, anong ano niya? Debt to equity ratio. The one that you excluded.
0 din ata yun, sir, if I recall.
0 rin. So mukhang nasa lower end siya. No? So I'd say I'd not go as far as 40 if mukhang siya yung outlier in this industry. Okay, so I'll be a little bit more conservative and go sa lower route. Probably you can go as high as 20, but 40 might be possible, but my suggestion is, well, in the real world, how you usually do it is you'll understand why is Waterhouse 40% in terms of debt ratio, right? Kasi baka may iba siyang business. Kasi ilang percent ba ng business niyang brokerage? Lahat? I can't remember. Let me check the exhibit. Waterhouse. 99 pala. So mataas din.
99.
Bakit kaya siya may debt? So that's something worth, I mean, in the real world, that's something that you'll do. No? Kasi baka mamaya may debt pala siya kasi mismanaged. Right? So therefore, mawawala na rin siya in terms of the range of values that you can consider on what an industry number will be. So, I mean, in the case, it was not given to you. Why? Pero okay lang yun. In the real world, what you'll do is to investigate why is Waterhouse 40. Right? Kasi baka may opportunity naman talaga to increase to as much as 40. And that creates value for you. Right? Because leverage creates value. So, ganun mo siya dapat i-assess in the real world. Okay? Okay, sige. Yun na lang muna. Any other questions? Thank you, Den, for that question. What's your group? Then I should be taking notes of that pala.
We're group 1, sir.
Group 1.
Yeah,
Okay.
we're group 1.
Okay. How about the other group? Any queries? Hello?
Hi, sir.
Sige. Sige, go ahead.
Hi. Hello.
Yes.
can the group comment lang on one part of the case? Kasi there's a part there where it mentioned that baka naputol lang kanina nung naputol kasi yung net ko. Baka na-discuss kanina. So there's a part there which says na E-Trade management continued to insist that E-Trade, even though yung revenues niya from brokerage operations, so they don't want to be considered as a brokerage firm and should not be valued as such. So ayun lang. Can the group comment on that?
Hello, Rojan. In our analysis, basically, even though they said they're not in the brokerage, they don't consider themselves as such. In our analysis, we considered them as part of the industry because in substance, as what you can see in the brokerage revenues in the exhibit, 95% of their total revenues is coming from their brokerage business. So in that case, it does for us it doesn't really matter much because in substance they're actually a brokerage firm. So for our analysis, we consider as such.
Yeah, I agree. So even if they say that they're not a brokerage company, but if the nature of their company is brokerage, then yung kanilang comparable should be brokerage companies. Of course, it assumes that they will not change their industry. I mean, the assumption of this, the fact that we are using discount brokerage as the comparable company, it means that they will remain to be in this kind of business. But for example, they provided a strategic direction, for example, that they'll invest in investment services. And they raise the funds so that they can buy an investment services company so that their brokerage revenues will be 50-50. Then that changes fundamentally the comparable company moving forward, right? So in that case, hindi mo na lang titingnan yung discount of brokerage, but you'll also look at investment services also. So I think that was highlighted in the lecture, di ba? Yung cost of capital calculation, that's using the own information from the company, kunyari own stock prices, right? If you compute for the beta that way, or to compute for the cost of capital inputs based on the stock price of the company itself, you're assuming that whatever will be their future business makeup is the same as the current, right? But if there are strategic differences, then you might need to change the cost of capital so that it will consider the cost of capital basis, so that it will also consider yung perspective, what will be the basis of the company, what will the business makeup of the company prospectively. Okay.
Thank you.
Any other questions? Wala. Sige, I'll ask the question. The first question is, let's go item by item. So essentially, we're trying to compute the cost of capital, right? So since this is 0% debt, then we focus on cost of equity muna, right? So if you go by CAPM, then we start with the risk-free rate, right? What was the decision for the risk-free rate? Ano yung ginamit ninyong security, and why? Why that security? Can you explain further so that everyone knows? No, I mean, what was the basis?
Hello, sir.
Yes.
Okay, so for the risk-free rate, sir, we use the prevailing yield on U.S. government securities, and actually we use the longest yung maturity, the 30-year bonds, which is at 6.61%. But the rationale kasi, di ba parang from the definition, the risk-free rate parang should match yung investment horizon na tinitingnan ng company. That's why we use 30 years kasi kumbaga the investment of the company, they actually expect to benefit from it for the longest possible period. That's why we use that.
So that's the main reason. The main motivation for the risk-free rate is investment horizon in terms of choosing the security. So kung 3-month ba yan, 1 year, 5-year bond, 30-year bond. So you choose the longest tenor possible, or not really longest pala, but the tenor that matches the investment horizon of the investor. Okay? So that's the basis, right? Now, doon sa long-term bonds, diba may 10, 20, 30 year, right? And then dun sa baba, sa historic average total annual returns, I'm looking at Exhibit 3. Okay? So if we're looking at Exhibit 3, meron doon na long-term bonds, B, okay, na 6%. That's an annual average return. Do you think it should be used or yung prevailing yields? Anong kaibahan ng prevailing yield na 20-year, say for example 20-year, 6.69% versus the long-term bonds na B, nandyan na, let me annotate. So ang kino-compare ko ito, oops, sorry may tumawag sa Viber ko. Ano ba yan? Ang kino-compare ko itong 20-year, tsaka ito, 6.69, 6. Okay? So, ang pinakaiba nila, 20-year prevailing, right? Which is the current yield to maturity. Okay? Ito, average yield to maturity for 1 year. When should I use this and when should I use this? Hindi ko alam kung nalagay ko pa sa lesson ko yun. Kung hindi, di papaliwanag ko today. Okay. So, theoretically, what's correct is this. No, tama, yung ginawa ninyo, you use 30 years, 6.61%, which is the prevailing yield, the current yield on the bond. Kasi the theory is, if you're an investor at nagko-cost of capital calculation ka, kung ano yung yield today of an alternative investment, then that should be your basis for the risk-free rate. Okay? You only use an average like this if the current or prevailing rate is unreliable. What do you mean by unreliable? For example, there is a crisis the past 3 months, and therefore the current rates are not necessarily a representative of future rates. No? If that's the case, then you should do an averaging. No? I-average mo yung yield sa past year or past 2 years so that could more or less correct for whatever dip that's happening now. Okay? So that's one caveat lang, no, that we should take into consideration. Okay? So for the risk-free rate. Any questions on that? Okay. I mean, the default is current yield, okay, and then it should match the tenor of the investment. So for example, kung ang aking project that I want to invest on, where from the point of view tayo of a corporation, hindi point of view of an investor. So for a corporation, meron tayong 10-year project na ini-evaluate, capital na kina-capital budgeting evaluation. The risk-free rate that you should use is the 10-year risk-free rate rather than 30-year because it matches the investment horizon of the project that I'm trying to evaluate. Okay? So here, kung napapansin nyo, na-integrate na yung financing and investment. No, kasi kailangan ma-match ng financing yung characteristics ng investment. In this case, the investment is in terms of the kind of capital projects that you are trying to fund from the point of view of a corporation. Okay? So the risk-free rate might change in your cost of capital calculations depending on the project. Kasi some projects are 10 years, some projects are 30 years. So ima-match mo yan, no, to get the expected return or the required rate of return of investors, which is the cost of equity. Okay? So yung risk-free rate, nag-a-adjust yan, depende sa horizon. Okay? So next, beta. So can we go to beta? how you calculated the beta? So there. So I agree with this Aljan, comparables to also eliminate e-trade, for the reasons mentioned. So essentially what happened was it was the asset beta was determined. If you looked at the asset beta here, actually kung titingnan mo, very comparable yung mga asset betas, right? 2.17, 2.2, 2.28, which means that our analysis, the empirical result sort of validates our analysis, right? Our analysis is that these companies are comparable, they are in the same industry, and therefore they face the same business risks, right? So even though your computed beta is so different from each other, right? Because that's the equity beta. It includes the impact of leverage. Excluding the impact of leverage, the asset betas are actually very near each other, which confirms our theory that they are really comparable companies, right? Kasi yung business risks that they are holding are more or less not the same, but at least comparable. There's no outlier between the three. So that's a good result. That's what you want to see pag kinumpit mo na yung asset beta. Kasi parang nako-confirm yung theory mo that they are really comparable companies because their asset betas are near each other. Kung may fourth ka pa dyan, tapos ang asset beta 3, then you have to parang check whether it's really a comparable company. Baka may characteristic siya which makes it really not a comparable company. Okay? So that's what I wanted to discuss there. And then, sorry, I'm looking at the case. Market risk premium. Okay. Market risk premium is based on what? Sige, could you discuss?
Sige sir, I'll continue na lang. So for this one, actually we had several revisions, no? Pero we use yung US government securities and common stocks for the period 1950 to 1996. For the reason na, kasi we thought the other option kasi is the 1929. Wait, let me check. Oo, which is parang mas matagal yung period niya. And we thought na that period kasi covers mga extraordinary events such as recessions, no? So the most recent one, yun yung ginamit namin. And from that data set, we use yung, what do you call this? Yung sa company stocks of 14% na return, and then yung bonds naman na I think it's 6%. That's why we have a market risk premium of 8%.
So again, what is the judgment here? The judgment is the how long the returns, the average returns is going to be. If you go from 1929, it will cover World Wars 1 and 2, right? So baka maging downward, parang baka maging biased, no? Yung kasi unless you foresee that in the same period you will have the same kind of ang idea lang naman here is yung CAPM trying to predict the future, no? And then the inputs niya historical. So ang basic principle lang naman niya is yung historical mo na average, is it something that you will also see in the future? And therefore, isama mo siya sa averaging. That's why usually ang ating parang what I mentioned in your in the lesson, okay, is that usually it covers one business cycle. No? Kasi if it covers one business cycle, then that's one business generation na pwede nating maging basis for predicting. And of course, the earlier the data is, the more reliable it is. Kasi pag masyado nang mahaba yung data, okay, baka may mga data point na hindi na relevant sa future, just like World War II or whatever. So you want it to be the shortest possible, pero not too short naman. to the point that it will only capture a certain wave in one business cycle. No? So I think I discussed last time that a business cycle is from one trough to another trough, okay? Or from one point to another point of the economy. No? So of course, you didn't have the liberty to compute for it because given na lang sa'yo yung historic average. But if I were you, I'll also be choosing 1950 to 1996, the shorter duration, because it is at least more updated or does not get bogged down by extraordinary events happening from 1929 to wala pa lang World War I yung 1929. World War II lang. 1929 to 1950, hindi na siya kasama. Okay? So again, it's a judgment call. There are also other methodologies for getting the market risk premium, pero medyo technical na, meaning a lot more econometrics is required, so we don't cover it na lang. Okay? But if you want someone to do it for you, you can check the, I don't know kung nabanggit ba to sa inyo ni Sir Dave. You can check there's an NYU professor who's computing for the market risk premium of all countries in the world. So si Damodaran, si Professor Aswat Damodaran. So you can also refer to him. He did the computations for you already on the determination of the market risk premium. Okay, but updated nga lang yun, meaning wala siyang historical. So yan. Those are all methodologies: rating-based default spread, total equity risk premium, and country risk premium. So yung mga yan, there's a methodology in his website that you can there's specifically an Excel sheet that you can download nandun kung paano niya kino-compute. So you can have an appreciation of it. Okay, so RM, RF, beta, risk-free rate. Tapos na.
Hello,
right? So
sir.
that's your cost of
Sir?
capital. Yes.
Sir, na-confuse lang kami dun sa risk-free rate. Okay, hindi ba necessary na yung gagamiting RF for the market risk premium is yung 6.61%?
Hindi kasi siya, yung 6.61, spot rate kasi siya eh. Meaning prevailing yield. So hindi siya match doon sa time period ng iyong okay, sulat ko ha. Diba RM minus RF, yan yung risk, risk premium, right? Yung RM galing sa average over a period of time. Right? Yung RF dapat match siya sa time period ng RM. Pag ginamit mo yung 6.61, 6.61 is prevailing, which means spot rate yan. Spot rate as of, anong date ba yan? August 31, 1997. So, hindi siya comparable. Okay, so I guess kailangan niyang i-clarify yun. No? Right? Kasi iba yung function ng RF na to sa RF na to. Okay? Itong RF na to is being computed because you want to determine the risk premium. Right? Oops.
Sir? Okay, sir.
So this RF is not necessarily always equal. Not necessarily always equal with that RF. Kaya if you look at the methodology of Damodaran, for example, directly niyang minimeasure yung risk premium. Hindi niya yung kinocompute na RM minus RF. But it's a direct estimation of that risk premium. Sige. Any questions on this? Sige, good that you clarified. Wala na? Okay. Any other questions on this one? So this is a very straightforward case, cost of capital lang talaga siya. And that was really the objective of this case. Siguro one thing that I want to emphasize pala is what they did on stock splits. Can you go to that slide? Okay. Remember, pag may dividends, yung presyo, dividends on yan. Right? Correct? So, nagdo-double count ka ng return if you compute the returns based on this one. Okay? So, you should remove the impact of dividends kung dividends on. Pag nagko-compute ka ng monthly return na capital appreciation. Okay? Kasi itong monthly return na to, supposed to be that is dividends plus capital appreciation or stock price increase. Right? Pag hindi mo tinanggal yung dividends dito sa dividends on price, okay, then twice mong na-count yung dividends sa return. Right? So, hindi siya comparable ngayon. Okay, so dapat there's an adjustment for dividends to remove the fact that the trading price before the dividends is paid, okay, is cum dividends or including dividends. So that's one way to adjust it. Another is in terms of stock splits. So if there's a stock split, lahat ng transactions before this date, kailangan mong i-adjust yung price to effect the same stock split bago mo computein yung monthly return. Right? So that the prices before March 31, 1995 are comparable with the prices after March 31, 1995. Okay? So that's something that you should also do to adjust. Of course, you have, probably if your data set is so plenty at isa lang naman yung dividends or isa lang yung stock split, baka hindi naman ganun ka significant yung impact. Pero still, that's the correct way to do it. So, kung madalas yung stock split, baka malaki yung impact. I think that's it. Those are all the methodologies that needed some clarification. Any questions, concerns, or issues? Wala na? Pagod na ata kayo sa SEM?
Answer.
Wala nang,
Sorry.
wala nang humihinga. Wala na ako naririnig na humihinga. Sige. All right. So if that's the case, then we can stop now. So thank you to the group.